Hello, good morning. Good morning, everyone, and welcome to this Valuation Standard Board Valuation Manthan series. And today we are having 42nd session. So on every Sunday, our um, efforts to disseminate knowledge is going on and on. And the year since when we have taken this task. So, friends, a lot of things are happening, and this Amrit Kal of our nation, India, let us see what best we can contribute to the nation. And at Valuation Standard Board, we are coming out with two publications, and various things are there in the pipeline. Post, we have also received that a registration for valuation of plant and machinery and land and building at our IBBI, from IBBI at our triple IPICAI, and accordingly we want to ensure that everything goes well, and accordingly those standards are also in the pipeline and very soon will be released. It's very evolving and it's a process, and accordingly let us begin with this process in such a manner we involve everyone and evolve. And that is the mantra we actually take it further. And with these words, I welcome all of you to this 42nd episode of Valuation Manthan with Mr. Kishore Nuthalapati from Hyderabad as a speaker, and Anisa being the moderator. And I must appreciate the efforts of our chairman, C. Hansraju, and also entire office, which is really doing well, reaching out to all of you with this knowledge dissemination sessions. Friends, it is our endeavor to serve the best to all of you, our members and students. And with this, we are in connect with you. Let us understand if you need more support. We are always there. With these words, I once again welcome all of you to this Valuation Manthan series.
Thank you, ma'am. Thank you so much. Very good morning, everyone. Today, again on this Sunday morning, on behalf of Valuation Standard Boards of Institute of Chartered Accountants of India, I'm welcoming all the participants. Today is a Valuation Manthan session 42, and the topic is valuations of assets in a national monetization pipeline. And I also understand that this is a very new topic and it's very important. And this course, which was initiated by our under the leadership of our chairman, C. Hansraj Subsarji, and our vice chairman, C. Preeti Madam, it's for the benefit of all our existing as well as aspiring registered valuers. So our speaker for today is C.A. Kishore Nuthalapati. So I'll just give a brief profile about him. Dr. Kishore is an economist and a corporate finance professional with almost 25 years experience in finance, banking, credit, project management, HR, and legal. He holds PhD in finance, then ACS. He's an ACS, company secretary, and PG degrees in commerce, management, and law with the university level ranks. He is on several committees and boards. He has been contributing to policy making bodies. He addressed several forums in and outside India, including regulatory bodies, authorities, banks, and institutions. He is a regular speaker on TV and other media, authored many articles, and guided more than 1,000 research projects. Besides being a humble angel investor, he has been mentoring startups, MSMEs, scholars, and aspiring professionals. With this brief introduction, I request Dr. Kishorji to start the session.
Thank you, Anisa ma'am. Firstly, my thanks to Chairperson Preeti ma'am for gracing the occasion and for encouraging all the participants. The efforts of VSB are highly appreciable. In fact, I'm sure every member who has been participating in all these series of these sessions is benefited extremely well. I myself could understand by watching a couple of the past videos, and I was surprised that such a rich guidance, content, and knowledge sharing is happening free of cost. thanks to VSB, thanks to Institute, and Institute is like a mother and it is benefiting everyone. And special thanks to Chairperson ma'am and to other members, including Rahul sir, Preeti ma'am, for their constant coordination and then keeping in check with the speaker early in the morning, then 10 minutes before. So I think this courteous follow-up is the key for the success of all these sessions. And nice to see Anisa ma'am as the moderator. With that brief, thanks from my side and thanks to all the participants for participating and for making these Manthan series a grand success, because of which our chairperson ma'am spoke so proudly. I start the session. With your permission, I take the share screen. Fine. So we are discussing about valuation of assets in national monetization pipeline. We are not distinguishing between which kind of assets, because all assets are clubbed together in national monetization pipeline. And this discussion of ours is relevant and beneficial to all the three classes. A brief disclaimer without saying, we need to understand the backdrop of this infrastructure, the capex, and the burden on the economy and the user charges which government has to collect to facilitate the existence, the creation, existence, and the maintenance of these infrastructure assets. So for a brief time, we become economists from chartered accountants and other professionals. Then we'll go back to the valuer professionals. To start with, the savings and the GDP have direct nexus. Savings will form capital and capital. Sorry. Now also, sir? Oh, okay, sir. Sorry, I think I've done that. Fine, sir. Fine, sir. We'll do that, sir. Sure. Oh, I didn't do that. Sorry. Is it fine now, sir? Okay, thank you, sir. Thank you for guiding. Fine. So we are on the backdrop of the GDP growth from the chain link of savings. Savings do form capital, and it's a capital which forms the investments, facilitates and creates the investments, and investments in turn create the employment, and it is the employment which is the key in creating the M1, M0, M1, M2, M3 money circulation, which is very critical for the economic activity and the rise in the GDP growth. So the employment creates activity and assets. It is the assets, the creation of assets by virtue of creation of assets and by virtue of consumption of goods and services, which cause the rise in the GDP growth rate. Therefore, the nexus is capital to GDP. The base is savings, because savings create capital. Very interestingly, we could observe that the savings as a percent of GDP, which were very low between 60s, 70s, 80s, have started rising in 2000, early 2000, 2000 until 2010. But thereafter, from its peak of about 38.2, they started sliding and are presently at 22.8, 22.7, which means there is close to 40% reduction in the savings in the economy, because of which the savings and investment equation has been lower, because of which the gross fixed capital formation, which is the economic indicator explaining what are the investments made to create fixed assets, is also on a decline. As we could see from 2009, 8 and 9, there has been a gradual decline. If not very gradual, there has been a decline in the gross fixed capital formation. If gross fixed capital formation is lower, it means new assets could not be created. And as we all know, unless new assets are created, we aren't talking about tables, we aren't talking about jets, we're talking about fixed capital assets. And it is the fixed capital assets which cause a solid growth of GDP. Now, as this has been on a slide, just quickly to make you understand what is this gross fixed capital formation, I put this. As all of you understand, we measure GDP in three methods. One, income method. Two, production method. Three, expenditure method. While India formally has been adopting production method, the better method for economic understanding by finance professionals like us, it is expenditure method. Because if the money is expended, when we say expended, it creates the solid assets, the real assets. Income sometimes could be partly notional, partly real. And production could be produced, but the goods may or may not have been consumed, which again could be a less optimal method to understand the real sense of GDP. But when you talk about the expenditure, you wouldn't expend unless you have the source of money, which explains the real sense of GDP. From this third method, which is the expenditure method, we can understand that gross fixed capital formation is the key for creating the assets. And it is this gross fixed capital formation which is short in India because of less savings. That doesn't mean India need not sacrifice or compromise on creating new assets. The new assets, mostly infrastructure assets, are very key for the growth of the economy, for the better living standard of all of us. And it is on that pursuit government has been undertaking and implementing huge infrastructure projects. Every wherever you are located, whichever city you are close to, whichever village you are close to, the connecting infrastructure projects, as you could sense yourself about the projects around you, around your location, you can understand the kind of massive infrastructure projects which are coming up in India. It is about these infrastructure projects that we are talking now. Government has launched close to 111 lakh crores. In our terms, it is 111 trillion crores. 111 trillion. 111 trillion Indian rupees is the capex which government has announced to undertake various infrastructure projects, mostly in power, road, and railway. Of course, in the urban projects and irrigation projects and rural infrastructure projects, the next order of priority is visible. But for these projects of capex 111 trillion, the available funds with the government of India is less than 56% available from the identified sources. So in a pursuit to plan these projects, government has two options. Option number one, to levy additional taxes so that government will have the funds to meet these infrastructure projects development. Option number two, if government doesn't want to levy additional taxes and burden all of us, government has to borrow either domestically or from abroad, or has to print more money, which means now it's not printing, creating more credit and meet the requirement of the infrastructure development. And in this case, the second case, what we are speaking about, the debt burden hangs like a domicile sword on all our heads. And in turn, the debt servicing will have to be charged to all of us, which explains that additional taxes or additional debt or causing higher inflation by creating more credit, in brackets, printing more money. None of these three options would be solely advisable because all of these three will hurt the common man and all the professionals as well. And the other option, which many other countries have tried and have shown as successful if properly implemented, is monetizing existing successful assets without transferring the ownership rights, but by only transferring the revenue earning rights for a finite period. The finite period could be 10 years, 20 years, 30 years, or for a project like Mumbai Airport, 60 years. In that pursuit, government has understood the core infrastructure requires about 60 trillion. Of that 60 trillion, government identified that about 6 trillion could be generated from the monetization of assets. So this chart explains us the summary of the projects which government is implementing, and this is a very valid input from today, from the past 2 years, today, and next 5 years as well, because of this core 60 trillion, 61 trillion, which is about half, slightly more than half of what we spoke as 111 trillion. 61 trillion is the core infra what government is implementing. In that, the central government share from the budget is only 14 trillion. And what about the 43 trillion? It has to come from the state budgets, from the PSU sector units mobilizing their own debt for the proportionate share, and internal accruals slightly, and internal extra budgetary resources slightly, external aid and others, could be grants, could be other borrowings, could be creditor borrowings, etc. Now, as we could see, it is 14 trillion only what government could contribute to this, and the balance has to be mobilized from others, which also explains that there is a huge shortage even for the central government to mobilize its own funds. Now, the 6 trillion what we are talking as monetization of existing assets is part of this 14 trillion, which means about half of central government budget has to come from this segment. Now you could understand of 111 trillion, half is core infra. Of that core infra, about 14 trillion is central government's share. Of this 14, around 45 to 50% is identified as a source from monetizing existing infrastructure projects. So this is the importance of the whole thing what we are talking. However, we are talking about projects which are already existing. There are certain challenges for the government. What are those things? There are a lot of dead assets. They can't be abandoned. How to give life to these dead infrastructure assets? And there are many sleeping assets. They are not dead. They are less active, very less active. They are sleeping. And there are many assets, not dead, not sleeping, very active, but the capacity utilization has been very low. And there are many projects which are unprofitable, and viability has to be generated out of it. And there are many projects which are very good, be it it's not dead, not sleeping, capacity utilization is proper, profitable, but the features are less than what are desired by the users. You could recollect your own examples. It could be a bus stand, it could be a railway coach, it could be any other asset, it could be a stadia, any of these things. They're all good, but some of the features, what you expect, desire, are absent, or they're not keeping up with the development happening across to meet the requirements or the aspirations of the users. And how to avoid further debt burdens on the economy, which we spoke in our preamble, and how to generate new funds for new infrastructure projects, how to enhance participation of the private sector in the public projects, and the natural choice what government thought by studying about 20 other economies. They came out with this asset monetization plan, asset monetization pipeline. So this AMP is National Monetization Pipeline within brackets plan. It is about this NMP what we are discussing today, because as government has started this NMP, which will start more aggressively in the days to come, all of us, being financial professionals, should be aware of the valuation mechanisms, its impact on the economy, and the development of new projects, and the methods or the approaches of valuation which Government of India has announced as suitable for this NMP. Now, we go to the topic of the actual monetization. As I cited a while before, not for nothing that government has introduced this NMP. Not for nothing. Government did a good amount of research involving professionals like you and me. I am proud and you are proud that we have contributed many policy inputs to the government of India for the NMP. So the NMP was designed understanding the slips, the failures, the success factors, and the improvisations what happened across abroad, and those were considered in this plan so that we need not commit the same mistakes and we can benefit from the experience of having learned from the others. And good number of countries have adopted this asset monetization plan, and the proceeds were used to create new assets, sometimes for the revenue expenditure also, but our option is to create new assets. Now, what's the value proposition of the transaction? How a monetization of an asset will happen? Among our learned participants, there are few or many valuation professionals also. As we all understand, imputed value is a pre-starting point. So the moment you stand before a building, for example, even without knowing anything about the land value there, even without knowing anything about the market demand there, even without knowing anything about who is owning it, is it for sale or not, is anyone interested to purchase or not, you can, out of your intuition, assign some guess value for that asset. You would say this could cost some 40 lakhs, 30 lakhs, 1 crore, whatever. Without understanding any of the basic metrics or the inputs to assign a value, you could come out with a guess number. It is called imputed value. Government also has started with imputed value because most of these assets aren't put for sale until now. Therefore, they started with a imputed value. That is called imputed value. It is guesswork value. But kindly note, imputed value is not opposite of the actual value. It is like the difference between theory and practice. They're not opposite. There will be some gap between these two, just that. Then the starting point is headline estimate. What is headline estimate? The best example to take you through is market multiples. If you want to purchase a 3-star hotel, someone tells you there is a 100 keys 3-star hotel up for sale. You have headline estimate which popped up in your mind instantly. You don't have the paper, you don't have the pen, nor do you have the calculator, nor the system, but your brain could do the math in a second. Why? Because you know that in India, a 3-star hotel per key will go at 4.5 average capex value. So 100 keys hotel into 4.5 per key, you came out with 450 crores is the valuation. Similarly for a tower asset, similarly for a road asset. So most of the assets will have headline estimates. Are the headline estimates the actual values? No, yes. Yes, because they are the starting point. No, because they would require some adjustments. In our case of hotel, 3-star hotel, 100 keys, what if there is 20 acres valuable land attached to the hotel? Then do you think the 20 acres will be ignored? 20 acres itself could cost 2000 crores. So are you valuing the 2000 crores land and the hotel put together as 450 crores only? No, the land value will have to be separately valued, and that is what we said as adjustment to the headline estimates. So we make the headline estimates, which are broadly the market multiples and are very relevant because market has discovered this price. Market is trading assets at this price. And if you want to purchase hotel, you can't be stubborn in offering anything lower than 4.5. You will not be foolish in offering anything more than 4.5. At the same time, you will not be unwise to ignore the other assets which would warrant adjustment to this valuation. That is the importance of this headline estimate. Then comes government is monetizing assets. It is not giving to Dr. Kishore, it is not giving to Priti ma'am or Dimple ma'am or Rahul sir. It is adopting a transparent competitive bid process where the competent companies can participate in the competition, can offer their price, and then win the project. The price is discovered by virtue of competition. It is the price discovery which is the beauty of the market. As we all understand why these stock markets are much bigger than all of the players together, each of the player individually, because the discovery of the price happens in the market dynamically. No one can sway the market of a purely liquid stock. They could at best try to influence stocks which are less liquid. Once a stock is reasonably liquid, let's say 40 to 60% liquidity is there, that stock is the darling of the market because it benefits the investors with the trend of demand and supply of the market, and no one, including the promoters or including the big stock brokers of the market, can influence such kind of liquid stock. So the price discovery, which is the beauty of the competitive process, is adopted, and the true price discovery is derived as per the market demand by virtue of the tendering process, competitive process. And once the price is discovered, the value is arrived at, as we spoke a while before, with the suitable and warranted adjustments. Once the adjustments are made, the valuation is arrived. And thereafter, after you arrive at the valuation of the assets, it is not that private is purchasing the asset, they are participating in the asset. So they would offer the price what they are willing to share as a revenue or as a premium, as a royalty, as a concession amount, whatever. That is the consideration what you are expecting from the private sector who are participating in this national monetization pipeline to be owners for a finite period. Then the payment structure will be finalized, will be discussed and finalized. What is the payment structure? Will you make upfront payment and thereafter derive your capex, your returns, or would you offer revenue share out of the revenues what you get? And there could be multiple methods as well. And payment mechanism. How is the payment mechanism made? For example, as we all see, the national highways today have online tolling system. The developer or the toll operator of the road cannot cheat or dupe anyone with the falsified numbers, as the every payment what is made with the FASTag or with the online challan payment is directly created into the escrow account, which is online and in the cloud, open to everyone, more particularly to the government. So the revenue what he collects is visible. Once the revenue is visible, then the share distribution, the share apportionment is automatic. It is more clerical and procedural. So this is the kind of robust mechanisms what we are seeing now, unlike earlier days where the revenue has to be reported within 7 days by the toll collector, and he would do all of his adjustments or whatever he would do, and whatever he reports is the revenue for the government, and he would share only some of the revenue what is committed by him. Therefore, the government stands to lose, the public stands to lose, and the private developer, if is a falsifying player, would benefit at the cost of all other players. With this asset monetization, what are the benefits to the government? Are there any benefits? Tremendous benefits are there. Optimal risk sharing can be achieved. All of us could vouch that the government is best at creating huge infrastructure assets, be it airport, be it seaport, be it bus stand, be it any complex, be it stadium, etc. But then the operation isn't well or is less than to our satisfaction, because the operational expertise, the agility is less with the government because of their own limitations. How do you get it? You can get that from the public, from the private sector, and collection of revenues. Government may not be very competent to collect the revenues from the users. It will have to be sensitive. If not, we are not using the word responsible, it is responsible. It has to be sensitive, sensible, and it has to go by the mood of the situation and the policies, the politics, public agitation, etc. In which case, it may not be able to be absolutely financially strong or financially wise. But private sector will not let anyone get exemption unless they are stated as exempt. So private sector has the efficiency in collecting the revenues, in maintaining the assets, in upgrading the assets, and in assigning the proper fee, and in collecting more. So those private efficiencies can be availed after the risk sharing also. Then locking of the funds. You have developed an asset, you have sunk the capital, the asset is fine, and the amount is locked up in the asset forever. Forever. It is not your residence that you lock your capital forever, for lifetime, for generations, and you will not count it as available. The other assets are meant for cycling for the economic development. But if government couldn't monetize the assets, its amounts remain locked for a longer time. That can be avoided by asset monetization. And how do you get upfront funds? So by monetizing, you can get upfront funds also. For example, one of the jewel of Hyderabad, which is called ORR, Outer Ring Road, was monetized by the government for 7,200 crores with a concessionaire period of 30 years. So upfront, one shot, government got 7,000 crores and certain stamp duties and processing fee. In all, government got close to 7,500 crores upfront. Now imagine, to collect this 7,500 crores in any other route than this route, government will have to think of either higher borrowings or levying more taxes, both of which will not be acceptable to the general public. Of course, we are talking about state government, and state government can't mint money unlike central government. So the only method could be monetize the existing assets which can command upfront amount to the government. Then the service requirements of the public can be catered, but through private. Now, we could sense the difference in the maintenance of the road pre-privatization, post-privatization. We are able to see a lot of repairs being taken up, a lot of amenities and other things being improved because private is smart. They are business centric. They have profit motive. Therefore, they improve upon the facilities and try to charge as much as they could, so long as the users are willing to pay for it. And there are some slips which we'll discuss in the subsequent slides, and your questions could be reserved so that we can take them at the end. And the greenfield projects, which are new projects, can be taken up with suitable models only when you have this monetization plan. And as I briefly spoke, the asset monetization is not about transferring the ownership. It is only transferring the revenue earning rights for a finite period only. The finite period is subject to change depending upon the asset nature, but it is either for 10, 15, 20, 30, 40, 50, or 100 years, whatever, but the ownership remains with the government. So, dear learned professionals, if you could recollect your experience of having accounted for the road projects or bid projects, you have considered the BOT annuity projects as intangible asset and the BOT toll projects as intangible asset and the BOT semi-annuity projects as financial assets. Because where there is no further, of course, these three valuation methods are also suboptimal as we understand, but there is no better option, and therefore government has chosen or institute has chosen to issue guidelines on these lines. And now the matter is settled that all financial returns, annuity projects are financial instruments recognized in the balance sheet as financial instruments, and the tolling projects are intangible assets. This has been the settled law, settled guideline from our institute. This is being adopted across the country by all the developers, and that explains us that the ownership is not with any of these developers. Ownership remains with the government, but be it intangible asset or financial asset, you are owning it only for a finite period, which is the concession period only. Therefore, it is not outright sale of assets to private. There is no scope for the private people or the opposition parties or the economists like me or the pseudo professionals, whoever would criticize every government in the name of publicity that assets are being sold. Assets are not sold. The limited rights are sold for a finite period. Limited rights, finite period. Then the regulatory tariff mechanism, the RTM, which we call in short as RTM, the RTM is well in place, which means private is not allowed to charge user fees as they wish. they are regulated with the regulatory power still remaining with the government forever, even during the privatized period also. So you aren't exploited. You cannot be exploited by the private other than within the curtains allowed to the private to charge their fee to recover their returns and principals. Then as you succeed with the asset monetization, you can look at similar many things and emulate successful operational models in the other projects as well. For the investors, many of you must be in practice, in employment, and maybe working for infrastructure companies or developers. And you would understand, you would try to understand what are the benefits to your companies or to the private sector. Now, you are acquiring a yield compressed asset. What is yield compressed asset? This is a beautiful concept. Now, every project could have broadly three phases. After the risk phases are completed and the project becomes operational revenue generating, it has crossed past the risky phase. Now, an asset which is stabilized and is showing consistent revenues now and into the future has very less risk, if not zero. Assets which are with very less risk will command lower capital requirement, lower return requirement from the investors. It could be equity investor, it could be lender. Lender is okay to lend at 7%, 8% to an asset which is less risky. As you all know, there are IRAC norms, income recognition and asset classification norms, which stipulate or guide a bank to have their capital apportionment. So the capital weighted risk apportionment is dependent on the risk. Once an asset crosses the risky phase and becomes a certain asset to give certain return, lender is okay to give at a very benign cost of capital loan. Equity investors are okay to expect very low return, and it is such kind of equivalent blue chip assets what you are procuring. So does it mean low return? Yes. Does it mean low risk? Yes, very low risk. But investors are eager to invest into yield compressed assets. Which kind of investors? The likes in the India, the likes in our country and abroad. Today, as we stand now at this point of time, India's largest real estate owner is Blackstone, not Indian company. The second largest owner, again, is not Indian company, Brookfield. Third largest, again, is not Indian company. Fourth, fifth, sixth are the ranks are shared by our Indian real estate behemoths like DLF, Godrej, and the Hiranandani and the likes, which means the assets became yield compressed assets. The return is hardly 4% to 6%. And this kind of 4 to 6% return will not enthuse Indian investors. And we have better assets to invest and make more money. Therefore, the yield compressed assets are meant for someone who has benign cost of capital like LIC, like maybe the pension funds or the likes of Blackstone, Ontario, CalPERS, CPPDQ, CPPAP, and AIF, then the Kaizen from Kaizen, then GIC from the Dubai, all these companies whose cost of capital is very low and our cost of capital being high. Now, it means now you would have understood, recollected from your memory that if Ahmedabad to Mumbai speed train, the bullet train, could mobilize 50,000 crores loan from Japan, which carried hardly 1.5% interest, 1.5% interest per annum, not per month, and a 15-year period moratorium. It is possible because Japan has lower cost of capital. Its interest rates used to be negative, now 0.10%, versus Indian present interest rates of about 7.16, 7.17. Government GSET 10 years yield is 7.17 to 7.18 versus 1.5% interest, which means government also stands tremendously benefited with this, and so are the private users, because when the cost of capital is low, which goes into the pricing of the usage of the product, we also tend to benefit by paying less amount. This is the concept of yield compression. Then there is a flexibility and ease of mobilizing debt funds because it's a government asset and you can transfer the SPV. Although you are an investor, private, you can also transfer during the construction period, which means your liquidity isn't blocked. You also have liquidity with you, although you are the concessionaire. Then you are with government. Let me ask you, let me run a simple example with you. All of you must have seen Tanishq, Titan, and there is another carrot lane. There are two more products under that, each of them having, few of them are listed companies and they command huge brand value, and every girl would love to have that watch on her hand, on her wrist, and every gent would love to see the big watch getting shoved on his wrist. Why Tanishq, or for that matter Titan, commands so much of brand image? One, because it is from Tata Group. Two, because it's a joint venture between Tata, Government of Tamil Nadu, and Government of India. The moment something is a joint venture with Government of India, your perception towards that company, towards that product will be less hesitant, less doubtful. You will not have, is it sold by packing or branding at a higher price? The doubts stand quelled at the upfront itself. And if it really has any additional features, you don't mind assigning a higher price for its brand image and for its authenticity. So that is the brand image a private sector can command by being a partner with the public sector by participating in this asset monetization. And within the allowed concessionaire agreement, you can maximize the returns and build your expertise. How do you maximize returns? The structure is so beautifully put that if you have higher operational efficiencies, you can earn more while giving a share to the government. So, higher operational efficiencies, more the returns or more the income, higher the returns, higher the shares to the government, and higher the share to you. Yes, it benefits everyone, and users are happy, will be happy to pay so long as better services are rendered. When you are purchasing an asset from the government, you have sovereign immunity. Some other private party cannot come and then claim and create a clog. Clogs are absent when you are purchasing from none less than the king, the sovereign. So that is the advantage. And you can participate in various sectors and you can diversify or increase of your exposure or your footprint in various sectors. And what we are speaking are all brownfield assets. What is that? There is brownfield, there is greenfield, there is yellowfield. What is brownfield? It is brownfield when it is a stable asset which can give you returns without any or with low risk and with certainty. Certainty being high is with brownfield asset as it has already come into existence. It passed the stabilization period. It proved that the returns would flow to the owner and therefore it is brownfield. Then yellowfield. It was brownfield, but it requires a bit of redevelopment, a bit of expansion, a bit of improvisation or improvement, upgradation. That is yellowfield. So yellowfield is also less riskier, but relatively higher with relatively higher risk than brownfield, because in brownfield the additional capex is generally very low. In yellowfield the additional capex is substantial. In greenfield the greenfields are destroyed to create a new asset, therefore it is greenfield, non-existent until now, therefore greenfield. In case of greenfield, the development risks are very high. You do not know if the project is the need of the hour. Will it have the footfalls? Will it have the pricing power? Will it be viable, feasible, and viable? You will know all of these things. Therefore, greenfield projects are very, very risky. But asset monetization is selecting brownfield assets broadly, few of them yellowfield assets, again understood as brownfield only. Therefore, the development risks are very lower for the investors. Now we get to what is this NMP concept. While we have understood it briefly, or maybe the complete understanding is formed, we are now looking at the sequence of what NMP is. First of all, what are its objectives? To serve as a medium-term roadmap for the ministries and agencies. So all of us, each of us is having opportunity to undertake valuation assignments from various ministries. A private party may ask you to assign valuation so that they will be able to mobilize their required debt. The government sector, government or any of the PSUs will ask us to assign a valuation so that they understand what is the price discovery that could be expected from this asset monetization. The banker could ask us to assign a valuation or to take up valuation assignment and give a report because he would like to understand, he or she would like to understand to what extent the LTV, the loan to value, can be fixed by them as a policy matter. The IBs, the investment bankers, will ask us to give an evaluation report because they would like to understand, are they syndicating the optimum debt aren't. So valuation would be required by multiple stakeholders in the process, and we understand that we should be prepared to take up these valuation assignments. So is the concept being discussed today. And this objective is medium-term roadmap for all the ministries and agencies. That is the objective of NMP. Then it provides the medium-term visibility to the investors on which infrastructure assets are identified for monetization, what is the time schedule of this monetization, and if someone is planning, there is no private sector stadium. Let me start a private sector stadium. If that is your thought, you will not be misguided because today itself you can see that the government stadium is out on an MP map. Therefore, it doesn't make any sense for you to waste your money and raise another stadium because you will have to divide the revenue between you and the government. You would not like to do that because you will lose. So will government lose, of course. So what do? Either you will drop your idea, or if you're keen to own a stadium and be and derive the benefits, you will bid in NMP and you will own the limited usage rights of the stadium. Look, this is like our revenue guideline, what we give to our investors. It avoids the uncertainty and it gives the informed decision making platform to the investors. And it provides a platform to ministries to track asset performance. So what is the nature of asset? And then you are suddenly, until now, never has this been exercised in India. Suddenly, all the assets are being tracked. They are being enumerated, means listed out. They are being valued. They are being repaired. They are being redeveloped. Look at this kind of development. Never has it happened. With a small program of 6 trillion, which is yet to see its full light in the next 4 or 5 years, we have seen a great shaking in the whole infrastructure assets, and everything is now being enumerated. So the misuse and the lack of proper ownership titles all will be addressed with this kind of valid exercise, and greater efficiency and transparency will be derived because when private takes up, they'll be answerable, they'll have to earn for themselves, and they have to pay you the fee as well. So this I explained, it is not transferring ownership, it is only giving concession. What is it, concession? Concession will allow the private investors to make their money by operating and by charging from the users. And where required, they are also tasked with the regulatory responsibility of upgrading the assets, widening the assets, enhancing the features, or starting projects or extending projects into new areas. This we have discussed broadly. So I skip. Okay. This is what the essence of NMP is. The framework speaks about monetizing rights and not ownership. So upfront, as this is spoken, the scope for an economist like me to criticize the government or the ministries is zero. They are mostly brownfield assets. Mostly. There are few greenfield and yellowfield also, but mostly brownfield assets. Therefore, there are stable revenue streams for everyone, including the government. And the partnerships are structured. We spoke about RMT. the regulatory mechanism on tariffs. It is not that private can charge whatever they would like. They have to charge what they disclosed, what they submitted as their tariff plan. They cannot deviate from this. Therefore, broadly, they are regulated even by the government in terms of performance standards, in terms of features, in terms of charges, and everything. This is the pictorial explanation which government has given in NMP policy documents. It is the same what we discussed. So, okay. 1 2 points of this we'll quickly look at so that we'll understand. There are about 13 asset classes which government has listed, and the entities are the government entities or the ministries which are owning them. And what is the key asset variable? If you recollect our previous discussion, we thought imputed value. Headline estimate is multiple. 4.5 crores value per key of a hotel is what headline estimate. This building is so beautiful. I wish I own it. This must be, say, 1 crore rupees. So the guess of 1 crore is imputed value. So to assign imputed value, you need to understand the key asset variable. It is the key asset variable on which the imputed value or the headline estimate are assigned. So these are 13 asset classes. Anyway, presentation, I think the presentation will be shared with all the participants. Therefore, the number wise, we are not bothered much, but some numbers are very critical. Now, in this slide, you could see power generation and power transmission and gas pipelines, all of them terming them as power or energy, are about close to 20, roads 27, railways 25, which means around close to 75% or 70% plus is from these three sectors only, which are the real requirement of Indian economy. Roads, railways, and power are the three most key core infrastructure assets for Indian economy. And without developing these three, the Indian economic development would be a big question. Therefore, the focus of NMP has always been on these three. Rest also found place, but less in magnitude and relevance. Now we came to the valuation approaches. So all of you are aware of the three approaches which our institute has been teaching us, and you have been adopting in your for your exams, for your practicing, for your valuation, internal, external, all those things, which are asset approach or cost approach, income approach, and market approach. Asset, income, market approach. Aim for the best. Okay. Because you aim for the best when you value an asset, the outcome. While we have been discussing these three approaches, we also have been adopting multiple methods under each of these approach. In asset approach, what are we adopting? Book value, cost of building, and depreciated value, or IDV, insured declared value, etc. They're all methods under the asset approach. Similarly, in income approach or under income approach, we have few methods. What are those things? Darling of all the valuers, and so is it for me, DCF, discounted cash flow. I could explain a theorem from my perspective that everything is DCF, be it valuation, be it ownership, be it business, be it life, be it relationship, be it friendship, everything is DCF. I could explain that way. So it is having that logic to get adopted or assumed and spoken that way. Then under this income approach, we have discounted cash flow method, then direct capitalization method, direct cap method or capitalization method, yield cap method, Elwood method, and few more methods. Similarly, under our market approach, we have many other methods like your EV by EBITDA, sales multiple, many multiples are there. Or the multiple what I have been speaking, because it's an easy example. What is that? Per ton cement capacity for trading is 800 crores. Simple, or sorry, I am discussing about hotel. Yeah. That is also a valid example. But to make it more relevant for the participants, many of them are being young. Per key, 3-star hotel value, capex value is 4.5 crores. That is the in vogue trading value of a per key hotel. So that 4.5 crores is asset or capacity multiple under market approach. Similarly, for a bank, 1.5 to 2 times is the valuation multiple on the sales. So that is a multiple approach. So all of these things are regular understanding in asset, income, market, aim approaches and the methods thereunder. Is government working on different approaches? Not really, but they are slightly modified to suit the requirement of national monetization pipeline. What are those approaches? Same as what we know and we have discussed briefly now, but with a small difference which holds logic to suit the requirement of these infrastructure projects. Market approach. So what did government say? Government said we adopt this approach for assets which have comparable market transactions. So hotel, at some place or other, every day there is a hotel which is up for sale, being sold, being discussed, negotiated, etc. So there is a comparable market transaction. Road, every day there is one sale or what happening in the market, in Indian market. And transmission line, less frequency though, but there are market transactions. Power plants, there is a dialogue happening everywhere, one every day, somewhere or the other on trading of power plant. These have, for example, hydel power around 8 crore rupees, solar around 5 crore rupees. Now people are saying 3 crores, but standard PV panel we speak about 5 crores. Road 6 crores, 20 crores, depending upon the status, etc. Circuit transmission line 1.5 crore, etc. So these are all the multiples prevalent in the market which are broadly used pre-adjustment by the sellers and by the buyers. So if you want to purchase a school and become a school owner and you find somewhere school for sale, 1,000 students, your brain could do the math without pen and paper, without calculator, without computer, and you'd say, fine, 5,000 goodwill per student into 1,000 students, fine. This is the value what the seller must be expecting. Let me see if there are any other assets associated warranting adjustment for upwards. Only then will you look at the other part. But otherwise, you have the headline estimate readily available on your tip of fingers. These are all market approach valuations. So this method is adopted because it is easy to adopt and market is much smarter than each of us. Market has discovered this price and therefore everyone is following that. And it is not that it remains static. Kindly note, at some point of time, 20 years before, when I used to attend our classes in our institute Chennai, we were told that 1 crore per key hotel, 3-star hotel is a valuation. 1 crore per key. Thereafterwards, when I have been participating in government policy making, when I served government, we were discussing about 3 crore rupees, 2.75 crores. Today, as I did a quick check last month, the present going price per key is 4.5 to 5 crores, which means the market approach multiples are also dynamic. They do change, but at a given point of time, what is prevailing is from the market and can be blindly adopted, after which you could give the warranted adjustments. Having started with the market approach multiple, you will give consideration to certain things like what's the quality of asset. 4.5 crores per key is a value, but is it same for a hotel in Jaipur and Delhi, Mumbai, Hyderabad, Chennai, Bangalore, Kolkata? No. Within that same city, will it be the same across? No. It also depends upon location, quality of assets, and are you monetizing the whole of the hotel or are you monetizing only one part? So it depends on each of these factors as well. And of course, the consideration will be finalized by understanding over what period of time would the private party derive its benefit. If GMR Aerocity is given 66 years concession in Delhi, it is because the government realized that such a capex could not be recovered in 30 years. If airports are allowed for 60 years concession period, why did government do so? Government realized that if private has to collect all of its principal and returns within 30 years, that will burden us, the users. It could be the same for railway, bus stand, or any stadium, anything. If private is allowed, rather required to make its income over 60-year period, what are you doing? The fixed cost burden is spread over 60-year period. Therefore, the user charges will be lower and it will be affordable to the users who need this facility. So the payment concession will also depend upon the time value of money or the period of concession. Then, of course, the demand and supply. What is the demand existing will be the key. There is Taj Mahal up for sale, just 10,000 crores, fantastic asset, nowhere available, peerless, all fine. But then there is no demand for it. What do I do purchasing that asset? So demand and supply also do play a role in the competitive process. We discussed about the price discovery mechanism being the beauty of the market with an example of stock markets. The capex approach. So some of our friends, when we discuss, including learned professionals, they confuse between methods and approaches. Asset, income, market are approaches. DCF, then EV by EBITDA, or EV by per ton, or cap. These are depreciation method, book value. They're all methods. Methods are under approaches. Each of the approach has several methods under it, and we adopt. First, we discuss what is the applicable or suitable approach. Then we go to what method is suitable. So our flow of explanation, the reasoning to our client will start with the nature of the asset and why it should be valued. Then what is the suitable approach? Then what is the suitable method to value the asset? And then you explain the balance part and the outcome, of course. So in the capex approach, now understand why capex approach. What is capex approach? It is just equivalent to, in simple English, it is cost. Whatever you incur is a capex approach. Why should you allow someone to pay only the exact cost? Is it justified? Yes, it is, dear learned professionals, because there is no power project. And if no one comes from private sector to develop a power project there, who has to take it up? Not you and me, government. And by avoiding the investment of this capex, government is saving its money to spend on other required assets, which means wherever there is absence of the project and the responsibility rests with the government to develop this project, capex method is very much suitable, because in the first place what you require is the asset there catering to the requirement of the public, the users who are deprived of this service. Then comes the question of who would fit the capex, who would make the returns, and who would own the asset. Those are secondary to the private people or to citizens who are in need of the service. It is with that motive of creating an asset to cater to the requirement of the users that the government chose capex method is also applicable. So broadly that, then we move to book value approach. So book value approach we do adopt, in which case most of you from plant and machinery, P&M valuers must be adopting book value approach. For all plant and machinery, which you call as condemned, used, and then they are just about to get scrapped up, all those things, refurbished, about to refurbished, blindly you will say book value. That book value approach is also adopted in NMP in such cases, in same cases, such as plant and equipment, industrial buildings, then let's say port, seaport. Some of the seaports are privatized, and many have criticized that seaports are given for a song. No, they didn't understand the logic, the economic logic involved in valuing such kind of assets. There are no two similar ports. When there are no two similar ports and there are no comparables in the market, there is no comparison. No comparables, no comparison. When there is no comparison, you cannot assign any value other than what is lying in the books of accounts. For industrial buildings, for ships, the vessels, tugboat, pilot boat, mooring boats, then the ships or the barges, all the vessels, any kind of vessel, PSV, any kind of vessel, for all of them, book value approach is suitable. And let us say the book value is 1 rupee, which you found in many cases. Long back, it was depreciated even in the government accounts in the single method of accounting, or when they upgraded double accounting system. Therefore, the book value is 1 rupee. Does that mean you transfer the asset at 1 rupee and 25 paise of it revenue share? No, not that. In such cases, what you do is you will have other methods. What are the other methods? You must be insuring your asset, and for insuring, you should be declaring the insured declared value. Whatever you declare is not the final amount. The insurance underwriter, surveyor, and the technical expert would form a panel, inspect the asset, assess the asset, and will assign a value which they call as IDV, insured declared value. Unless you take insurance cover on this IDV, they say they will not give the insurance cover, which means if you make a claim, the claim could come on this IDV because they believe it is this IDV what explains the true value of the asset, not what you paid, not what you have in your books of accounts. IDV as a method is part of BV approach only, but IDV has come to the fore and is now being widely used for the book value approach also. Then EV approach, enterprise value approach. EV approach is where you know the exact stream of revenues that can be earned from the asset. For example, one of the train is privatized. Just imagine one of the train is privatized and the train has full demand, 1,000 seats, 100 rupees per seat per day. So what's the revenue? 1 lakh rupees per day revenue. This explains that if you can maintain the train properly, all 1,000 seats would be occupied, would be commuted, 100 rupees per seat will be collected. So 1 lakh rupees per day should be the revenue. If I give you, or if you give me concession of this train for 10 days, how much should I pay? Or how much should I declare as revenue? 10 lakhs. 100,000 seats commuted, 100 rupees per chair, 1,000 into 100, 1 lakh rupees per day into 10 days, 1 lakh. Simple thing, 10 lakhs, simple thing, is it? Yeah, 10 lakhs. So I should be paying 10 lakh rupees for 10 years or 10 days, or I should be declaring revenue for 10 days as 10 lakhs. Now, what is the NPV of these 10 lakhs? Whatever is the discounting rate you apply, and it is 10 lakhs. Now you are in Switzerland. Same example, 1,000 chairs, 100 rupees per day, 1 lakh, 10 days, 10 lakhs. You are in, for a moment, all of us are in Switzerland. What is the discounting rate in Switzerland? What is the interest rate in Switzerland? 0, negative? Yes, it is 0. Let us not take negative, let us say it is 0. Sweden, Denmark, Norway, Japan, then some of the parts of the Slovenian countries, all of them have what? Either 0 coupon or negative coupon. But for the simplicity of calculation, let us say we are in Switzerland, Brussels, and let's say the interest rate is 0. Therefore, the discounting rate is 0. Then what is the discounted amount of this 10 days revenue? 10 lakhs, because interest rate is 0. Now, what is this? It is discounted cash flows. For what period? The concession period, 10 days. What is this called in our terms? Net present value. So net present value is the essence of EV approach. Net present value and not DCF. Now, in enterprise value approach, what you have is the value of the asset, the value of the entity. So a pipeline is usually valued with EV approach. The overhead equipment of a railway station is valued with EV approach. A gantry crane or a davit is valued in a port sector is valued with EV approach. Why so? Because the revenue stream is certain, the period of concession is known, and you could discount all what you collect and state as net present value. That is EV approach. Now, our learned friends, many of you should have rightly got a doubt. Why did we not discuss discounted cash flow in these approaches of government? And Dr. Kishore, you are claiming time and again that DCF is your darling and our darling. Why is DCF not discussed? I'm sure many of you also know the answer. It is not discussed, it's not part of these approaches because one, it's a method. Two, it is not even included even as a method. Why? Because in DCF, the value comes from two streams or two sections. Section number one, the revenue, what could be reckoned for a finite period of 3 or 5 or 8 or 10 years, and thereafter you call the stabilization period, and you call the upfront of that as terminal value, and you discount the stable period revenues, the finite period stable period revenues, and the terminal value from the end of the finite period. So these two, the valuations from these two sections put together is discounted cash flow valuation, which means only when an asset has infinite lifespan counted or reckoned can you use DCF. I repeat, only when you consider an asset as perennially owned by you can you adopt DCF method. What are we discussing in our NMP? Assets are transferred, not sold. They are transferred with usage rights only, the revenue rights only for a finite period. So the permanent ownership isn't transferred. When there is no permanent ownership, there is no terminal value. When there is no terminal value, the DCF has no meaning, or least DCF is equal to LPV only, because there is only one section. I'm sure you would have got the doubt cleared if you had. Fine. So these are the approaches they suggested in the NMP. These are all suggested by the government. Imagine what kind of exercise government would have done. Of course, with the inputs from our institute, inputs from economists, inputs from the policymakers and the civil servants, they have done tremendous amount of research and understood what is the valuation approach. It was a surprise for me that we are claiming 20 years experience in this field, but there is a lot of science which has gone into this document, even on the valuation approaches. Slightly unbelievable that government could have this kind of knowledge and smartness, which should be actually our own monopoly. It's quite surprising, positively surprising. Then roads, market approach. So I run some of the examples and then I'll take you to the imputed values than wasting your time. Roads market approach means multiples. Ports, capital capex approach. Because there is no port, if there is no port, government has to create. Then dedicated freight corridor, track infra under dedicated freight corridor, book value approach. Whatever is the book value will be considered. When is the book value approach adopted? When there is no comparable. When there is no comparable, the book value itself is the relevant valuation. A port to be valued, port to be valued. Can you imagine what kind of insurance we should take? Don't tell me the capex of 6,000 crores only. No, capex could be 6,000, but insurance cover would require 1 lakh crores, 2 lakh crores as an IDV. Because if a port catches fire, touch wood shouldn't happen, but it would happen. The port's loss, what the insurance company will have to pay, could be in lakhs of crores. Lakhs of crores, not just the 6,000 crores required to construct the port. The collateral loss, the environmental loss and collateral loss, and the catching, spreading fire loss could be in lakhs of crores. Therefore, IDV is higher. Therefore, the insurance company will participate as a club than alone. And if you're talking about any port, whatever is in India, it may come as a positively surprising factor for you. That would have been reinsured with all the insurance in the world, almost all, if not all, almost all. That is the kind of risk diversification and reinsurance what they do. Then power transmission market approach, power generation book value approach. Because power generation assets do not have comparables. Transmission, there are comparables. Transmission lines are abundant in nature for comparison. Then sports stadium, no sports stadium, you have to create capex approach. Mining capex approach. Now, one point what I would request you to remember, any redevelopment blindly capex approach. Any redevelopment blindly capex approach. Any asset heard as traded in the market approach. Any asset not having comparison, book value approach. Any asset which has finite life and will have to be moved after that period, EV approach. Simple. These are the imputed values assigned by the government of India in LNP policy document and the guideline documents. They said per kilometer 4-lane road 6 crores. So some of you must be surprising. Our own company, Beckham, has participated and we are implementing 3 government projects, public-private partnership projects. And the average cost, normative cost for us is 22 to 24 crores. Then where is the 6 crores coming? It is because it is a brownfield asset, but in the nature of yellow field asset, which means while the revenue streams are stabilized, there is major maintenance and repairs component, MMR component, which is hanging on your head, and you may have to invest a capex of about 13 to 15 crore rupees on this asset to bring it back to complete usage. Once in 5 years, road will have major maintenance and repair. Once in 5 years, every ship will have major dry dock. So we had a fight with some of the big four colleagues on this calculation of dry dock. Once in 5 years, what is a ship? Ship is a company, isn't it? All of you know it. Ship is a company. It has 10 shares. Each ship will have 10 shares with IRS. And maximum there can be how many shareholders? 2 shareholders in holding 1 share. So there can be a maximum of 20 shareholders per ship. And once in 5 years, the ship will have to undergo dry dock. And how much would you be spending? Around 15 to 25% of the capex. You heard it right. 15 to 25% range of the actual cost of new ship will be spent once in 5 years. Does this mean every 5 years you capitalize this 25% and double the value by 20th year? No, it doesn't mean. It doesn't mean that way. This is called major maintenance and repair nature. So it is like if I tell you I bought my bike at 50,000 rupees 5 years back, and this 5 years I spent 10,000 on repairs and I spent another 40,000 on fuel. So now I want to sell my bike for 1 lakh. Will there be any taker? No, certainly no. Just as a humor, but that is not the approach. Then what is the approach? If I sell it as a residual asset, then I undertake the repairs, painting, etc. What will it fetch? So if I sell it for 10,000, then my sister will purchase, my other friends will purchase because they are willing to pay the balance 40,000 and make it as good as a new one and use it. Why not go for a new one? And then of course they would go. So they'll be willing to pay anything lower than 40, higher than 10 as spread over 10,000. That is how the market approach will discover the price and facilitate sellers, buyers, and the government or the users as well. Railway stations, tier 1, they said 500 crores will be the imputed value, tier 2, 300, tier 3, smaller cities like Kolhapur, etc. Nasik, Kolhapur, etc., 85 crores. Passenger trains, the actual cost of the compartments, the bogies, rolling stock, plus overheads. Private freight terminals, capex approach, but they assign a value of 21 crores per each goods shed. Dedicated freight corridor, book value is approach, and 30 crores per kilometer is the valuation. Overhead equipment, EV, as per the actual NPV. EV is equivalent to NPV in our case, as you heard. Then other assets, the same style of imputation. Hydel power 7.5 to 8, solar 5.5. So you may be surprising why it is 5. You may get surprised why 5.5, market says 3, 2. No, these are with the panels requiring replacement over 7.5 to 10 years, not once in 3 years. Therefore, high value assets. Power transmission market approach. Power transmission. There are multiple companies owning the transmission assets, including private and government, and the transmission assets are being traded. Therefore, there is a market assigned valuation. It is 1.58 crores per each circuit kilometer. Power generation, there are fewer assets. There are no equivalent assets. Therefore, 7.5 and 5.5. So we have here hydropower assets, solar power assets, power generating assets, power transmission assets. Power generating assets will have book value. Why? Because these will be unique to each of itself. These are comparable. Transmission line is same across India, wherever it is. Capacity is the standard capacity. Therefore, this is market approach. Here, book value approach. Natural gas EV approach, product pipeline EV approach. Okay. So other things broadly the same, which we discussed in the examples. Now, if it is all so beautiful, so it appears so simple, is it challenge free? No. There are some challenges associated with this national monetization pipeline within brackets plan. What are those things? All of us know how difficult it has been for the government of India to privatize Air India. It's not so easy, how much ever good it is. And we have seen how long government has been stuck with SCI, the Shipping Corporation of India, or BML, which it has put them on the docks meant for sale, but it not do it. So it is not so easy because of the bureaucratic process. And there are some assets like stadium, private public stadium. They don't have any assets. Then there is no revenue. It will become very difficult for you to assign an estimate of what people will be willing to pay to participate or to use this playground or stadium or one of the new assets, etc. There is no ferry. Suddenly you want to build a ferry and you don't know how much people will be willing to build because there is no revenue stream. This is what greenfield or sometimes yellow field if the features have to be upgraded. And some of them are yellow field, like in the road case. Once they are yellow field, again upfront huge capex is required. It's a challenge. Private sector will not be willing to pay upfront capex. They would like to own and use their efficiencies, derive the profits, and share with you. But capex could be a challenge even for the private sector. Banks may prefer to fund only big corporate houses, the conglomerates. The top 15 conglomerates in India are enjoying 50% of the debt of the country. Or is it? Yes, it is. Then if you and I compete, we may not be able to get the support from the bank in terms of loan. Then if only few could mobilize debt, if only few have the equity in their pockets, it will so happen that these few will be able to bid and own the assets, the ownership, not the ownership rights, the lease rights in the NMP or the usage rights in the NMP. Wouldn't it create monopolies? Yes. Or oligopolies, triopolies? Yes. Monopoly, triopoly, oligopoly could get created. That's a challenge. These are the challenges which government has addressed, is addressing. And government is yet to give comfort to the private players that regulation is unbiased, coordination is timely, and risk support is there. What is risk support? Risk support is, let us say there is a road and you bid 10 crores and you back the road. Tomorrow, just tomorrow means next year, let us say both the cities on the other sides of the road are became inhabitable. Then you don't have commuters, you don't have traffic commuting flowing, you don't have revenue, and you are put to loss for no mistake of yours. So in such a case, risk support has to forthcome. How? Government has to give you some other concession, they have to compensate you, or they have to allow you to toll in some other place, some other way. Such kind of risk support is important. It is not that private want to donate. Private want to invest and share their revenues. There are no donors in the private sector for that matter. So risk support is also very critical. These are the challenges which government is facing. Are there only challenges? Are there no responsibilities? There are some responsibilities. Auctions in NMP, the price discovery mechanism, the sensitizing demand and supply have to be transparent. Valuations have to be undertaken by you and me, the valuation professionals. There has to be transparency in the valuations. The rights only have to be transferred. In the guise of transferring rights, ownerships should not be transferred. There are some assets which could have finite life, and transferring ownership rights tantamounts to transferring usage rights, tantamounts to transferring ownership rights. That should be carefully handled by the government to avoid transferring the ownerships. Now, I'm a private conglomerate. I will bid and bag a project, and all of my equity is debt funded. One at the parent level, two at the SPV level, and therefore there is no equity from my pocket coming onto the table. And I own this asset. Is it fair? No, because private sector is expected to have its skin in the game alongside with the users, alongside with the government. Therefore, there has to be a minimum loan to value LTV ratio so that private also will have some skin in the game. It could be 75, it could be 70, whatever. It need not be 85. It need not be 60. It could be 70, 75, something like that. So that the private will bring 30. And 30 is good enough for a private sector to have its skin in the game. Then we are speaking so beautifully the manuals, the policy documents, that these proceeds will be used for new projects, which are national infrastructure pipeline projects. That should be ensured. And we discussed about RMT, regulatory monitoring tariff mechanism, regulatory mechanism of tariff, the RMT, regulatory mechanism of tariff. The tariffs have to be regulated. You shouldn't liberate the private sector or the players to charge whatever they would, and balance private and public interests in a judicious manner. You shouldn't benefit private, nor should you benefit only public. There has to be a reasonable, rational balance. Set a model for participation by quality private players. When quality private players come, then everyone will be benefited. Then periodically you discuss the progress and receipts. Unfortunately, NMP did not see complete disclosure, while occasionally our elder sister FM has been making some announcements on the progress, but a complete required disclosure statement is yet to come. Maybe we'll expect it from this July as the full budget gets presented and approved. Then ensure consistency in the policies and their implementation. We just have a quick look at the infrastructure assets what are being developed in India, which will give you a quick look of a quick look to see what kind of assets are being developed in India. A quick look of a video showing the assets. All of you must have seen it. Sir, oh, is it? Oh, sorry, how come, sir? How come? Oh, I thought it is visible. 1 second, sir. Please excuse me. I thought it is visible. Share screen, optimize, then here, then share. Sorry, sir. Just 1 second, sir, please, sir. Sir, is it visible now? Or is it visible now?
No, sir.
Okay. I'm again goofing up, same like last time. So, how do I do share?
2 million temples,
And now,
300,000 mosques, and
Yes.
hundreds of palaces
sorry,
serenade India's massive landmarks. But these are next to nothing compared to the mega projects currently under construction in India. A jaw-dropping road network carved through snow glaciers on top of a mountain. An $18 billion train project that will be 10 times faster than regular trains. And what could be the longest sea bridge in the world are just a few examples of what India is up to. But India is not new to engineering mammoth-sized projects. The Taj Mahal, which is also located in India, is one of the 7 wonders of the modern world and a testimony of India's architectural excellence. Built in 1632 by Emperor Shah Jahan, the ivory white marble tomb is over 200 feet high and laced with 28 different precious stones sourced from Tibet, China, Sri Lanka, and India as well. With the remains of his late wife Mumtaz Mahal lying beneath, this story of love and engineering excellence stands at the right bank of River Yamuna in the Uttar Pradesh state of India. India is the second most populous country in the world, and one intriguing thing about this unique country is their love for building gigantic projects. So join us as we take a look at the biggest mega projects currently ongoing in India. They all are breathtaking and groundbreaking at the same time. First on our list is the bullet train project that costs a whopping $18 billion in development. The bullet train is going to be 10 times faster than the regular railways and will travel at a speed of 350 kilometers per hour. The National High-Speed Rail Corporation, in collaboration with Rail Vikas Nigam, is constructing this 508-kilometer rail link with an aim to connect India's commercial city hubs, Mumbai and Ahmedabad. Launched in 2014 by Prime So citizens will also be able to save time for other schedules. Next on our list of mega projects is the world's first motorable road through glaciers. Project Himank, as it is called, was started in 1985 by the Indian Army's road-building Wing Border Road Organization. Not seen anywhere around the world, this impressive road link will be carved through snow glaciers around the Umlingla top mountains, encompassing a great height of 17,800 feet above sea level. Stretching from the city of Sasoma down to Saser La in eastern Ladakh, it connects the Dale Begoldi military base near the Chinese border. The contractors, however, have an impressive history of building great roads. In 2021, the Mountain Tamers, as they are called, received Guinness World Records certification for constructing the world's highest motorable road at Umlingla Pass, which reached a massive height of 19,300 feet. However, there have been a lot of challenges faced in this landmark project because temperatures at the mountain fluctuate during winter to less than -50 degrees and also rise to 12 degrees at the peak of summer. Engineers and workers have to descend from these great heights to get more oxygen, added to the fact that the snow melts more often. But despite any difficulties, the success of Project Himank will announce India's name in the history books as the pioneers of an enormous feat. Now, most of us probably know about the Eiffel Tower in France and have seen how magnificently it stands. But there's a new competitor about to outpace its record, the Chenab Rail Bridge. Standing at 1,178 feet high, India's government is spending $92 million on building the world's tallest rail bridge located in the Rayasi district of Jammu and Kashmir. The 1,315 kilometers long bridge covers the expansive Chenab River and is made of steel and concrete. It also has golden joints connected through high-strength friction grip that keep the two ends of the overarch deck together. The project started in 2017 and is a joint venture between 3 major EPC companies: Afcon's Infrastructure of India, Ultra Construction and Engineering Company of South Korea, and VSL India. Next project on our list is the Delhi-Mumbai Industrial Corridor project, valued at $90 billion. The 1,483 kilometers railway track is currently being worked into 9 mega industrial zones. Construction began in 2006 when an agreement was signed between the Japanese government and India, with an aim to create a quick, reliable trade route linking the north to the south of India. About 49% of the equity stakes are owned by the Indian government, 29% by the Japanese Bank for International Corporation, and a few individual government institutions. The project covers industrial cities like Uttar Pradesh, Delhi NCR, Haryana, Rajasthan, Gujarat, and Maharashtra. Another mega project worthy of mention is the $130 billion Bharatmala project. Bharatmala Pariyojana is a government-funded project that seeks to build highways throughout India to facilitate smoother transportation of goods and freight. The project will especially focus on connecting remote, rural areas, including tribal regions that suffer from a lack of basic infrastructure. It is the single largest outlay for a government road construction scheme and was implemented in 2017 by Prime Minister Narendra Modi. Phase 1 of the construction will be completed in 2026 and has tunnels, flyovers, bypasses, overpasses, elevated corridors, roadways, and interchanges, among others. Also, it is expected that over 550 district headquarters will be connected upon its completion, with an estimated 83,677 kilometers of land to be developed in the process. Moving on, India has done something quite fascinating, the kind of which has only been done once in history. The country has ventured into space exploration, but this time with a new twist. Though the project's budget is undisclosed, the Indian government launched the country's first ever mission to study the sun. The Aditya L1 is a space satellite with 7 payloads, and among them is the Visible Emission Line Coronagraph, designed by the Indian Institute of Astrophysics in Bengaluru. The satellite was launched on 2 September 2023 with the objective to observe the dynamics of the sun's chromosomes and corona. However, this spacecraft will keep a distance of 93 miles away from the sun, while observing the atmosphere and gathering information about its components back to its space stations on Earth. It is a testimony to the fact that brilliant strides are being undertaken by the Indian government, as only the United States have sent any satellite into space for a similar purpose back in 2018. Now, the Narmada River is so large that it has enough landmass to contain 3,000 dams, and the development of a series of dams along the river is one mega project the Indian government is embarking on currently. Having set aside $30 billion, the Narmada Valley Development Project, also known as the NVD project, is an ambitious plan to utilize the country's water resources in the Narmada River Valley region for the purpose of constructing a series of dams and canals along the river basin. This project is expected to generate electricity and provide irrigation systems as well as drinking water to the rural areas around Narmada. The project is expected to generate about 1,450 megawatts of electricity that will be produced from the Sardar Sarovar Dam. Upon completion, the NVD will break ground to become the largest river development infrastructure project of its kind in the entire world. With such a remarkable outlay for the power sector, India is moving towards becoming an industrial hub in the Asian continent, as the Gujarat and Madhya Pradesh regions will be home to several robust power plants in the long run. The next mega project embarked upon by India is the Mumbai Trans-Harbour Link, valued at $2.2 billion. The MTHL project is a freeway-grade road bridge that will become one of the longest sea bridges in the world upon completion. It is estimated to contain about 80,000 vehicles annually and will span through the entire Mumbai metropolitan area. The bridge is designed to start at Sewri in South Mumbai and terminate at Chirle in Nhava Sheva, crossing Thane Creek to the north of Elephants Island. The MTHL project, whose construction commenced in April 2018, will link Mumbai to Navi Mumbai with a wonderful 22-kilometer stretch of dynamic 6-lanes road bridge. Such a feat will be made possible through the supervision of the Mumbai Metropolitan Region Development Authority, who have awarded the contract to top companies like Larsen & Toubro, IHI Corporation, Daewoo Engineering and Construction, and Tata Projects Limited. With the number of mega projects currently going on in India, it is evident that the Indian government isn't only making plans, It is also implementing them in a bid to achieve its aim of becoming a developed nation by the year 2047. So what do you think?
So that's a brief video to give you a glimpse of what is the magnitude of investments which is going into these kind of projects. So we can take any questions and answers, please. By the way, I'm very proud to state that our company is executing close to 4,000 crores works in the same NIP scale, NIP schedule. And we've been doing a good job meeting the appreciations of ministers, central minister, and we also got an award for our qualitative work. So thanks to support of the government and professionals and everyone, whoever has supported.
Thank you, sir. So coming to question answers that we have received. First question is, please explain the parameters of risky phase, and if you can explain with an example, the
Okay, very
risky
good.
phase.
Yeah, very good. In fact, I thought of elaborating it, but I skipped. So it's a good question. In fact, I would appreciate the person who asked this question. For any infrastructure project, there are three phases. One, development phase. Two, construction phase. Three, ownership phase. In development phase, you involve in the tendering, identifying the project, throwing Swiss challenge, preparing the estimates, understanding the feasibility and viability, discussing with your bankers for debt possibility, discussing with your investors and the financial investors, discussing with the technical collaborators, discussing with the regulatory authorities, and understand that this is possible. And participate in the tender, win the tender, appoint the consultants for EPC, the plant supply, operations, maintenance, then the input supply, the material supply, then the offtake, which is the purchase and sale agreements. All of them will be done by the sponsor, by the promoter in the development phase. Once these all things are done, the development phase ends. Then commences the construction phase. This is axiomatic. Construction phase. The project will be constructed during this phase. Then comes post construction and post commencement of operations date, COD. You enter the ownership phase or operations phase. Now, development phase is the most riskiest phase. Development phase requires returns to the tune of 30% on an average, the normative number. Construction phase. Now, one step back, if you're a developer, for your development risk, for your development capital, for the development phase, you have to earn 30% return. And second phase, construction phase. If you are a contractor, EPC contractor like L&T, Shapoorji Pallonji, Afcons, and the likes, or the likes, J. Kumar, etc., or my own company became. If we are in construction phase, we expect 15% return on our projects. If you are in ownership phase, why you expect 15% return in construction phase? There are less risks than in development phase, but there are good amount of risks of completing the construction. Development completed, construction completed, ownership phase commenced, returns started flowing. Is it risky phase or risk past phase? It is risk past phase. In ownership phase, the returns are to the tune of 7.5, 30, 15, 7.5. Now, as the risk phase passes, as you enter the ownership phase of 7.5% return earning asset phase, a normative or an usual Indian company cannot remain invested because, as all of us knew, the average interest rate on a business loan, infra loan, personal loan, anything, is not less than 8.5 to 10%. Let's say 8.5. And if you have to service your debt at 8.5, would you be better off earning only 7.5 from your profit project? No. you would be better off by selling off the asset. Who will purchase? I spoke in my examples, the likes of Mapletree, Jurong, Sarbana, Blackstone, Brookfield, Calpers, JICA, then the Ontario, CPPDQ, CPIBB, Cube Highways. These are the players operating in regimes, in jurisdictions where the interest rates are either negative or very low or zero. Therefore, they are better off. Even if they could earn hardly 3%, 4%, and because of this reason, post risk completion, that is during ownership phase, capital flight happens to India, so will it happen to other developing or emerging market economies, EMEs, and they invest in these economies by acquiring these assets, which gives them certain returns for a long period. If Calpers or the Ontario, world's largest pension funds, their asset value is more than our GDP. What do they need? They do not need any returns. They need lowest possible return, but almost zero risk. That is their requirement. No return is okay, but risk is not something which is acceptable to them, because pension fund has to preserve the capital to make it available for distribution, which you call as rendering or redemption, when there is a requirement of the person who ceases to live or to the beneficiaries. So these are the three phases. These are the three return possibilities, and the need for each player or participant in one of these, each of these three phases.
Thank you, sir. Coming to the next question. In what ways does the scale of economies affect the extent of assets monetized?
It does, ma'am. It does, ma'am. The reason being, you would not be willing to go and invest in an economy like Sri Lanka, Venezuela, or let's say Pakistan, or maybe the smaller countries, or Iran, Iraq, or any of these countries. You would like to invest in an economy where there are huge scales of economy, number one, and the model what a government in a big country, in a relatively big country like India, Pakistan, China, etc., developing countries but big countries, relatively bigger countries than Sri Lanka, etc., is more certain, because see, if these countries are administering a model, they will not be able to abort the model just like that. They think a lot, and once they launch a model, it could be privatization model, asset monetization model, or selling model, developing model. They stick to the model and they administer the model for some time until it proves to be very, very futile. So the stability or the political risk or the large scale economies will be higher as the economy scale is bigger. Therefore, in a bigger country, you would see a lot of capital coming. Very specific example, we are not criticizing why Sri Lanka has not seen funds flowing or the capital flying from outside other than from China, because the capital flight always finds place in economies like India, where scale is visible. You would enter India, it could be Ola, Uber, Zomato, or any of these players, or for that matter, Foxconn, Apple, or Nvidia, Micron. You would enter an economy where scale is visible, because you could sense your long-term stay and your returns being certain, and you could absorb your fixed costs over a long term, and you'll be competitive. Mind you, the world's largest player, Uber, had to sell its business in Singapore to Grab in Malaysia and Singapore. Why? Because the scale is less there. It couldn't compete with Grab operating in Singapore and Malaysia. So it couldn't compete because the scale is so less for Uber to be dominant in those economies and compete with the local player. Therefore, it sold its business to the local player and came out. But in India, it's a dominant player. It doesn't see exiting from India in the near future.
The next question is, how is the per unit value determined for assets like roads, transmission lines, and power plants?
So specifically for a road, map, So my company, the company where I'm associated with, Beckham, we are now constructing three major Bharatmala projects to the tune of 4,000 crores. The cost of laying a road of a 4 lane, 2 lane, 4 lane, 6 lane, 8 lane will be usually measured by the government, by the tendering authority, adopting SSR, scheduled standard rates. So they arrive at bill of quantities. Bill of quantities will be converted into bill of materials. The difference between BOQ, BOM is in bill of quantities, the materials which go into the project will be listed out by the authority. You are deploying crane, you are constructing some formwork, you are constructing some shutter, some mold. These all will not be transferred and therefore they will not be used or stated, or some nails, some grease, some oil, diesel. These all will not be stated in the bill of quantities. Bill of quantities will state what will be transferred in one of the form to the government or to the project. So you prepare bill of quantities, bill of materials, and you make estimates, and then you understand what is the normative. Normative. Normative is something between imputed and headline, which means when we are saying normative cost of laying a 4 lane per kilometer road is 22 crores. Wherever you go, it will be 22 crores with small adjustments. In Ladakh, it will not be 22, it could be 80 because of the terrain. In Northeast, it could be 45. In down south, it could be 21, but broadly it is 22. Why this? Because this is a proven number which is as per the actual estimates drawn scientifically by the experts involved in the project execution. So is the case for power, 8 crores per megawatt for hydel, 5 crores per megawatt for like that.
So, next question is there any case where CAG has objected to valuation approach adopted for a particular asset? And if yes, what was their ground of objections?
Ma'am, CAG is our big brother, like our institute only, because they also conduct audit of public sector. Yes, there have been objections. I do agree, there have been objections, but then without going into nitty-gritties of it, there could be some technical grounds and there could be some practical aspects. See, until the errant private company shows its true colors, you wouldn't be able to sense that they will go wrong, or sometimes the risk could be so enormous that they will abandon it because they could not absorb it, and that can't be seen in hindsight. So the best of the companies which went bust, Enron, for example, who would have thought Enron will go bust? Why would we think when it is going well? So it's not so easy for us to expect. Yes, Altman Z score does explain, which in fact we have conducted one big workshop in Hyderabad for our at our chapter. All our CA students participated about 15 years back. We scheduled it for 2.5 hours. It went up to 6 hours. We do have these models, but they do not predict absolutely or 100%. Therefore, in hindsight, we could sense that this project, this company should not have been given, but prospectively, it is not so easy in spite of all care. So I'm not denying that there is nothing wrong or there are no shortfalls. These limitations do exist. We have to learn from the mistakes. That is what we expect and we believe it is happening.
In case of transferring rights without time limit is not tantamount to transferring ownership, how to fix time limit or exit clause?
There are two aspects in this, ma'am. Number one, in case of finite assets, where we are talking about, let us say, EV approach or anything, NPV. Let us say there is a stadium, commercial theater, which could be commercial theater. Let's say one of the a planetarium, etc. Government-owned planetarium. There are a lot of complaints that planetariums owned planetaria owned by government are not upgraded. They are way behind in India, and therefore the students' learnings are not happening properly. Like that. Let us say take this example. Then each of the planetaria will require about 50 crore rupees capex. Now, if you want to allow a private party to build new planetarium or upgrade it and run for 20 years. The private party should recover that 50 crores in 20 years plus their return. So the return expected by the private sector is dependent upon the risk associated with this kind of asset. Now, do you see people flocking to planetarium reducing if market is not good? Yes. Do you see people using the road getting less just because they're not having employment? No. Road will be used with less uncertainty, whereas planetarium could see footfall or traffic only when the markets are good. So certain assets will have their nature of revenue streams, and it is the nature of revenue stream and the nature of asset which will explain us, are they riskier or what kind of risk are we talking about. Depending upon this risk, the private sector will expect 12%, 14%, 20%. For example, the working group of parliament which worked in tandem with planning commission announced and has been implementing that power sector projects are expected to make 14% return only on an average. Out of your efficiency, if you earn more than that, it is okay. Out of your inefficiency, if you earn less than that, you can't complain. But 14% is what you will explain, you will include in all of your DPRs. Your power sector DPRs will hold 14% as the return. You would show out of our efficiency, we may increase it, but your base case method will show 14% as the expected return. Why? Because this is the expected normative return. So these returns and the expected returns, the risks, will play a role in understanding what period should be allowed to allow the private party earn its revenue. GMR Aerocity, Mumbai Airport, Hyderabad Airport, ORR, why these are given to private for 60 years? Seaport 30 plus 30 plus 30, 90 years. Because it's not easy to collect back the principal and returns on a project which has capex of 20,000 crores, etc. Therefore, the period will be dependent upon the affordability of the users to pay it, the risk appetite of the private, the nature of the asset, the capex required to raise this kind of asset, etc. And at the end of the period, it will be transferred to the government. So this is another beautiful point what I would explain. Every infra project will be domiciled in a special purpose vehicle company. And at the end of the period, with one strike, one share transfer form, the whole of the asset, the company which owns the asset and is ring fenced without any loans, without any other assets, without any clogs, will be transferred from the private sector to the government with one signature, one step transfer, demat, one step transfer. Ma'am, you are mute, ma'am. Anisa, ma'am, you are on mute. So you aren't audible.
Yeah.
Please.
So sir has excellently answered to all the queries, and it was a very wonderful session and giving thorough an insight of the overview of valuation of assets in national monetization pipeline. Sir, a very excellent delivery supported with a very good presentation and also the video which actually gave an idea to all the participants. So what exactly this valuation is related to. Then you have covered a topic like needs and source of funds for infra, assets monetization, the benefits to investors and government, objectives of NNP, framework features, then NNP assets and the various variables, valuation approaches that can be used like market approach, capex, book value, EV approach, then various assets and related approaches to be used for to valuing those assets and challenges. So the topic has been explained in detail, and it was, I'm really sure that all the participants must have gained a deep insight and explanation during the whole session, and it has benefited to everyone. I present a hearty vote of thanks on behalf of Team of Valuation Standard Board of ICA and all the participants. Thank you, Dr. Kishorji. With this, we come to end of today's session. Thank you and have a great day ahead.
Thanks to all of you. Please.